Okay, Rudy here. Special Australia Day topic discussion for you around the Barbie tomorrow. Interest rates and the banks and property trusts. Okay, so let's start with the Australian 1-year government bond yield rate. So this is the big picture since 2000. So we bottomed in COVID. There's your declining wedge break. So we got a peak of 4.6 back in October 23. We've come down, we've broken another declining channel here. And if that was a share, you'd probably buy that, wouldn't you? So that's telling us 1-year rates are going up. I think the RBA, especially now, unemployment doesn't seem to be an issue. The only other lever they've got the only thing they have to worry about is inflation, which is not under control. Electricity, gas prices not going down, rents not going down. If they increase interest rates, loan rates going up, new building construction prices going up, insurance going up. So unfortunately, it's a blunt tool, but well, the market's already deciding interest rates. They want higher rates. We look at the 5-year, take a big picture. So back to the 1980s, this is where I'm sure some old timers would remember interest rates at 15%. Young people wouldn't have would be going, what the? So 5-year government bond yields, I'd call that a breakout. Aussie 10-year, just look at monthly charts. So again, right at the bottom, 2021, and we're breaking out above a key level here. So that's going up. None of this looks like interest rates are going down. Then you've got the 30-year with a beautiful little pennant squeeze. That's a perfect chart stock buying chart there. You'd be buying all those charts if they were shares. Okay, so there's your first topic of discussion. Interest rates and your mortgage rates. I did put one of these videos out about a month or two ago saying fix your home loan rates. I think some of you did. It's probably all been baked into the pricing now, but anyway, suss it out. Okay, so the banks. Okay, so alright, just my quick overview of the banks. So basically annual profits flat, operating expenses up, loan volumes are up for now. Net interest margins, which is how they make their money, between what they borrow, what they lend, and what they pay, that like term deposits minus loans. But there's cracks showing due to competition. You got like Macquarie's now becoming undercutting them because they're a lot more efficient. But the big one is just the outlook for earnings growth is dismal. Then you've got redundancies, AI, unemployment. Will unemployment become an issue? Then we have high unemployment, high inflation. Loan defaults might start coming through. If you slow immigration, that'll put a brake on house prices. So I'm doing this video too because everyone says I always say to buy stuff, never to sell stuff. So here we are at the banks. So it just did nothing and then boom. Okay, so here's a little special for you. The old parallel channel. So if we take this bottom here, connect it through the main sort of low there, and we connect it to this top here, we get pretty close to a top there. Now we've got the old, for those words, a head and shoulders, a shoulder head and a right shoulder that's a bit dwarfed, but it's the cone of death. So the banks need to do some oomph, some heavy lifting, and want to have really good reports coming out. And we'll just have a little look at what I'm into, the channel, which is our materials index, which looks a bit different to the banks. And if we just do a little ratio here, so the banks over the materials. So this is the materials out. So the banks, yep, you should have been in banks and not touching resources since 2024. And that's happened back here in 2011. You wanted to be in banks all the way. And then you wanted to switch in 16 because materials kicked the bank's ass. And there was a bit of a draw and the banks won, and now materials are where you're going to be. And the minimum it's going to come down and test. So that could be materials staying flat and the banks dropping, or vice versa, materials going up and banks going down. Alright, so that's enough of that segue. So let's look at the banks. So we got CBA. Got him he was a buy there, nice declining wedge break. But he's now on he's on key support, short-term support here. I've got a measured move down to this support area here. Doesn't mean he's going to do it, but he needs to get a wiggle on. ANZ. So ANZ's met its sort of short-term target, the depth of this cup. Add it to there. Bit of resistance showing there. Again, needs a lot more effort. BAQ, on the other hand, if you're going to buy a bank, you'd have to buy him 5.8 div. So Westpac. Well, that's the other thing too. The divs are not that. I mean, 3, 4. You get that in term deposit. Why risk your capital for minimal growth? I say. Again, Westpac. Measured move, the depth here, add to there. Bit of a cluster of resistance there. Hasn't broken support though, so no red arrows. NAB. No real measured move going on there, but a bit of a cluster of resistance up here happening. It needs to break through 44. The question is going to be, what's the impetus? Macquarie. Now it's a bit concerning that Macquarie is becoming a leader in mortgages and not a global leader in investment banking. Anyway, they're setting up a very interesting dome here. A breakthrough would be extremely bullish. However, that's an inclining channel, which is extremely bearish if broken. So that's still touch and go. Suncorp is gone. IAG is gone. QBE, I put a buy out in here the other week. I'd be using, if I bought it, a tight stop loss. Like if he drops below 1870, I'd be out. But he's the only one that looks half decent. Alright, the old VAP, a popular Australian Property Trust ETF. Again, a yield of 3.2. You get that in term deposit. And they are very interest rate sensitive. So rising interest rates are negative for property trusts. And we'll finish off with so most of the property trusts, like the big fella Goodman Group. So I put a sell out in him the other day when he had that spike, because they got that spike because they're going to invest $3.9 billion on a data center, building a data center over in Europe somewhere. My view on data centers is it sounds sexy, AI, data centers, yeah, got to make lots of money. At the end of the day, it's just a big factory with cooling systems. It's not as though owning the building and all you do is collect the rent. You're not like in some profit share of what's being created in that data center. And then to make it worse, in the leasing contracts, there's like, they want 100% 24/7 every millisecond of the year electricity generation, and if it's not, then you get penalties. So I'd rather just build a factory and lease it out to someone who can, although Europe's gone down our path and they're gone green and destroying their manufacturing industry. So I wouldn't be buying Goodman Group either. All right, well, hopefully that gives you... Oh, actually, we should crowd favourites, CSL. Not really, got nothing to do with interest rates, really. But the punters will be happy. That's a nice candle, green candle for me. And so yeah, if you love it, I'd be buying that. Well, actually, let's. So I'd be buying that with a stop loss down here, but it really needs to go 187 to be out of the woods. And Wes Farmers, I think I had a buy on him. That's a wrong sort of channel there already. Get rid of that. So he's just been so he's sort of got a nice, should have prepared this chart earlier, nice base forming there, so it would want to hold this support level, because Wes Farmers isn't out of the woods either. They've got the same sort of issues, and increase in energy prices, wage issues with the Fair Work Commission, logistics up, compliance, regulatory hurdles. So they're not like swimming in easy waters due to all this stuff either. But they're Wes Farmers. They're solid. All right. Hopefully that gives you some good juice to have a go at. All right. Have a good one. Have a good Australia Day. So yeah. All right. Hit the like button if you enjoyed that. The rooster likes to get likes. So yeah.